Welcome to Woods of Stardon. This is CH. I will be covering the FSSA Dividend Advantage Fund and the FSSA Asian Equity Plus Fund in this video, that are really the same fund with two different names. This is a refreshed version of the video I did in late 2024 and is part of my Absolutely Biased Comments or ABCs series. The aim of this series is to cover one fund per video to share how an individual investor can try to find out more about a fund from public sources and do some basic research or simple due diligence on the fund before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. FSSA has a rather complex history of rebranding and organizational change. Its history kind of started with Stewart Ivory and Company Limited, a Scottish investment company formed in 1985 from the merger of Stewart Fund Managers Limited and Ivory & Co. In 1988, Stewart Ivory set up an Asia team to focus on investments in the Asia-Pacific region. In the year 2000, the Commonwealth Bank of Australia, or CommBank, acquired Stewart Ivory. It combined all of its offshore fund management businesses, including Stewart Ivory, and rebranded it into First State Investments for global businesses and Colonial First State Global Asset Management for Australia onshore businesses. In 2012, the Asia team decided to rebrand itself as First State Stewart. Then, 3 years later in 2015, First State Stewart split into two separate entities. The team that we are focusing on in this video rebranded itself to First State Stewart Asia, while the other team became Stewart Investors. In 2019, First State Stewart Asia rebranded again into FSSA Investment Managers, which is the entity that we see today. In 2020, Mitsubishi UFJ Trust and Banking Corp, an arm of MUFG, bought over the business from CommBank. They then rebranded First State Investments into First Sentier Investors. Through the years, First Sentier Investors also acquired additional investment teams to broaden their business. We will, however, just focus on FSSA Investment Managers that remains broadly unchanged in what they do throughout the years. FSSA was initially set up and currently is still a specialist team focusing on Asia and emerging market equities. They are well known in the industry to take a long-term investment view, focusing on quality names, and are pure bottom-up stock pickers. They also consider themselves as an early adopter of ESG and responsible investing. Given their relatively long history, FSSA holds a reputation of being an early entrant in various key Asian markets, including China and India, and continues to run these funds today. FSSA runs an autonomous business while leveraging on the broader First Sentier Investors franchise. They manage about $31 billion of assets through the specialized investment strategies mentioned earlier. The reason why there are two fund names in this video, and that I mentioned they are actually the same fund, is that FSSA Dividend Advantage Fund actually doesn't run its own portfolio, but instead invests completely into FSSA Asian Equity Plus Fund. In mutual fund jargon, we normally call Asian Equity Plus as the master fund and Dividend Advantage as the feeder fund. This works a bit like a Russian doll, where Dividend Advantage is like an outer shell designed for Singapore investors, and inside is Asian Equity Plus that is the actual portfolio. The FSSA Asian Equity Plus Fund is a sub-fund under the First Sentier Investors Global Umbrella Fund (PLC) fund family. The fund family is set up as an Irish ICVC company structure and is UCITS qualified. The fund is registered as a MAS restricted scheme, which means it is suitable only for accredited investors. Therefore, you may find the fund appearing in some of the distributors' product offering list, but not immediately accessible unless you disclose your accredited investor status. The FSSA Dividend Advantage Fund, on the other hand, is a sub-fund under the First Sentier Investors Global Growth Funds fund family. This fund family is set up as a Singapore umbrella unit trust structure. The fund is registered as a MAS authorized scheme, which means it is suitable for retail investors. Now, remember, these are actually the same fund, so it doesn't mean that the MAS authorized version is less risky than the MAS restricted version here, just that the fund provider wanted to keep things simple and have only the FSSA Dividend Advantage Fund made available to Singapore retail market. The FSSA team is small and currently has 6 portfolio managers, who normally work as a team across the various funds they manage. They are physically located in Singapore, Hong Kong, and London, and most have worked in the team for the majority of their careers. Martin Lau is the key person responsible for the Asian Equity Plus strategy covered in this video. The FSSA website doesn't seem to provide manager bios, which is a pity. As per Morningstar, Martin has been with FSSA since 2002 and has over 30 years of industry experience in Asia and China equity markets. He is also a managing partner of FSSA. Morningstar also indicates Richard Jones as a previous co-manager of the fund, who retired in 2025. One interesting fact is that all the portfolio managers are also analysts, each covering sectors or geographic regions, and are responsible for the stock ideas that they recommend to be added into the funds that the team manages. Since the FSSA Asian Equity Plus Fund is the main fund, let's go through its investment objective and strategy first. You can find the fund in the FSSA Singapore website if you select Institutional Investor Access, since it's not registered for retail markets. The fund provides the same investment strategy in its webpage and fact sheet, that is to invest primarily in Asia Pacific ex-Japan equities, with a focus on potential dividend growth and long-term capital appreciation. The webpage is missing the investment objective though, which is important as it clearly states this fund aims to achieve long-term capital appreciation only. Do keep this in mind until we cover the other fund later. Let's go through the prospectus to find out more. The first parts are basically what is provided in the fund webpage and fact sheet. So let's see what else the prospectus has. It is stated here that the fund does not have any limit or constraints on country or market cap exposures, and can at times have concentrated country exposures. The only exceptions are China equities, specifically max 50% in China A shares and max 10% in China B shares. It is also clearly stated here that the fund will not use derivatives for investment purposes. So the fund relies on just plain vanilla equity investments, and investors who do not like derivatives would be happy with this. This follows with a lengthy section on the benchmark of the fund, that is MSCI All Country Asia Pacific ex-Japan Index. It is mentioned that the fund portfolio is not limited or constrained by the benchmark, and the benchmark is not a performance target for the fund. That being said, it only makes sense if the fund can outperform the benchmark over time. Otherwise, investors might as well just go with a passive ETF that tracks the benchmark index. There are no details in the prospectus covering the investment process. Fortunately, as a boutique investment team, FSSA has provided an investment philosophy webpage elaborating on their investment core beliefs that are applicable to all the funds they manage. Let's take a look at some of them that defines the fund's investment process. The team runs a pure bottom-up fundamental stock-picking approach and focuses on investing in quality companies as defined by the strength of their management, franchise, and financials. The team has a long-term investment horizon, with ideal holding period of at least 10 years once they have decided to invest in a company, so that the desired long-term compounding growth can be achieved. Given this long holding period, there will be times when their investment views go against the prevailing market conditions, and they end up being contrarians in the short term. These might be the times when the fund will underperform the broad markets, and investors should understand this before investing in the fund. With that, let's take a quick look at the FSSA Dividend Advantage Fund. You can find the fund in the FSSA Singapore website if you select the Retail Investor Access instead, as this version is meant for retail markets. It is important to note that this fund has a slightly different investment objective, that is to provide regular distributions alongside long-term growth, instead of just capital appreciation. This additional distribution objective is the key difference between the two funds, and we will go through that later. Besides this, everything else is being referred to the underlying fund, that is the FSSA Asian Equity Plus Fund, so I will not repeat the same stuff again. The FSSA Asian Equity Plus Fund was incepted in 2003, giving it over 20 years of track record now. Fund AUM is over $5 billion US, which makes it one of the larger Asia equity funds in the market. The FSSA Dividend Advantage Fund was incepted a year later in end 2004 with an AUM of over 4 billion Sing dollars. I am assuming the FSSA Asian Equity Plus Fund's AUM is inclusive of the FSSA Dividend Advantage Fund, which calculates to about 3.3 billion US equivalent. So the Singapore feeder vehicle is definitely a major contributor to the strategy size. The fund provides geographic breakdown and sector breakdown in its webpage and fact sheet, with index breakdown numbers as well for easy comparison. At a glance, we can see some differences between the fund and the index. The fund currently has overweights in China and Hong Kong, totaling about 36% versus the index of 26%. While the geographic exposure is a result of bottom-up stock selection, this does suggest the fund has more positive views on China market than the rest on long-term basis. The fund also has overweights in Singapore and Indonesia. In contrast, the fund is most underweight in Australia, followed by South Korea. Sector-wise, the fund shows more overweights in consumer discretionary, industrials, and communication services. On the flip side, the fund is underweight on materials, and in the others category, that will include all the sectors not covered in this list, such as consumer staples and energy. The fund runs a slightly concentrated portfolio of around 50 holdings. From the top 10 holdings list, we can see the fund can have quite sizable weights allocated to its top preferred companies. There is no weight constraint mentioned in the prospectus, though I think 8 to 10% should be the max. Otherwise, the single concentration holding risk would become quite high. FSSA does publish insight articles periodically, and these articles provide useful information explaining the rationale behind some of the holdings in the fund portfolio. For example, a recent February article explains why the fund picks 4 of the top 10 holdings as part of the AI team within its strategy. This is useful not just to give an update to investors on the fund's current views of the market, but over time, it is also important for investors to see that the rationale behind each invested name remains broadly unchanged, because the fund adopts a very long-term investment horizon approach. Let's get some additional information from Morningstar. From here, we can see the fund is focusing on large-cap stocks with no value or growth bias. These are also high-quality stocks with low momentum and volatility, hence generally have price stability. Financial measurements-wise, the overall portfolio has decently high earnings and growth ratios, but nothing too out of the norm. I want to particularly point out the portfolio dividend yield here that is currently around 2.57%, which we will revisit later. Bear in mind the FSSA Asian Equity Plus Fund has only a long-term capital appreciation objective, so dividend yield does not need to be high in the portfolio. As the two funds have different domiciles and are catered to different investors, there are differences in the share classes offered. Let's go through the FSSA Asian Equity Plus Fund first. The retail share class is denoted by alphabet I, which is less commonly seen as it is usually intended for institutional share classes. The base currency of the fund is US dollars, and for US dollars, it comes with accumulation, semi-annual distribution, denoted with H, and monthly distribution denoted with M share classes. The fund also comes available in Aussie dollars, sterling, and Hong Kong dollar currency classes. Do note there is no Sing dollar share class for this fund. The Retail I share class has a management fee of 1.5%. Adding other expenses gives a total expense ratio or TER of around 1.66% to 1.76%. Investors looking for a cheaper share class can try to find distributors that offer the institutional III share class that has a lower TER of 1.06%. Next is the FSSA Dividend Advantage Fund. Given this is a Singapore domiciled vehicle intended for retail market, FSSA has kept it really simple here by offering just one share class, that is a Retail Class A in Sing dollars with quarterly distribution denoted with Q. It is important to note that this fund is base currency in Sing dollars, which basically gives a Sing dollar unhedged performance of the US dollar portfolio of FSSA Asian Equity Plus Fund. To facilitate US dollar investors booking in Singapore, the same fund also allows for trading in US dollars, which is basically a FX conversion of the Sing dollar NAV. While this is supposed to provide the same US dollar performance as FSSA Asian Equity Plus Fund, the reality is that there are some small performance variations, as the two funds have different dealing time and therefore the daily calculated NAVs are slightly different. Plus, there are small FX conversion costs involved. The Retail A share class has a similar management fee of 1.5%, with a TER of 1.66%. Both versions of the fund allows distributors to charge up to 5% subscription fee for their retail share classes, although I think anything more than 2% for mutual funds is excessive. What this means is that for Sing dollar investors, the FSSA Dividend Advantage Fund is the only option to go for. For US dollar investors, however, it might be better to go for the FSSA Asian Equity Plus Fund instead, especially if you are able to access the institutional share class. Fund distribution is where the two versions of the fund have a notable difference. As mentioned earlier, the FSSA Asian Equity Plus Fund has a semi-annual distribution class and a monthly distribution class. The FSSA Dividend Advantage Fund, on the other hand, has a quarterly distribution class. I can't seem to find any distribution data in the FSSA website though, so we will have to rely on Morningstar on that. For the FSSA Asian Equity Plus Fund, the monthly distribution class was incepted only in 2025, and therefore has less data points than the semi-annual distribution class. However, on brief calculations, we can see significant differences in their distribution yields, whereby the semi-annual distribution class has been paying out around 1.4% to 2.4% per annum, while the monthly distribution class is paying out a much higher 5% per annum. Investors should bear in mind, we saw earlier that the underlying portfolio is generating only about 2.57% of dividend yield. Therefore, it is clear that the distribution class is sacrificing some of its capital gains or capital in order to provide the higher distribution yield, which is not ideal. Investors who prefer to leave capital untouched for long-term compounding growth should go for the semi-annual distribution class. For FSSA Dividend Advantage Fund, given it is a Singapore feeder vehicle created for Singapore retail market, its investment objective has an additional and specific objective to provide regular distributions. This leads to the fund having a quarterly distribution frequency that has the distribution yield fixed at 4% per annum level since its inception. Since this refers to the same underlying portfolio that has a lower dividend yield, it is also clear that this fund will sacrifice some of its capital gains or capital in order to provide the higher distribution yield, which is stated in the fund prospectus. So, to summarize this, only the FSSA Asian Equity Plus Fund semi-annual distribution class seem to provide a payout that is based on natural underlying portfolio dividend yield. The rest have a much higher payout yield, and therefore investors need to be prepared to sacrifice some capital gains or capital. That is not so ideal for a fund with a capital appreciation strategy. If you don't really need this income, I would suggest to simply go for the accumulation class for FSSA Asian Equity Plus Fund, or go for dividend reinvestment option for the FSSA Dividend Advantage Fund. The differences in the distribution yield do lead to notable performance variations over time. Here is the Morningstar chart comparing NAV versus total return for the FSSA Asian Equity Plus Fund semi-annual distribution class. With a lower distribution yield, we can see clear and meaningful NAV growth over the years. In comparison, here is the NAV versus total return chart for the FSSA Dividend Advantage Fund. With a higher distribution yield, the NAV has less prominent growth over the years. There are more performance data available in the fund fact sheets than the web pages, so we will refer to the former. Here is the data for FSSA Asian Equity Plus Fund, where we can see the fund suffering rather significant underperformance versus the benchmark in the recent years. In particular, there were performance gaps of more than 10% difference in 2025 and 2023, leading to disappointing relative returns across most time periods from 1 to 10 years. As the FSSA Dividend Advantage Fund is essentially a Sing dollar unhedged version of the FSSA Asian Equity Plus Fund, the same performance trends can be observed in its fact sheet and webpage as well. This, however, looks like a recent year's problem, as the fund still has a pretty stellar outperformance looking at since inception data. So let's take a look at Morningstar charts. It was difficult to find a relevant ETF with as long track record as the fund. The nearest match I can find is the iShares MSCI AC Asia ex Japan ETF, or AAXJ, that was incepted in 2008. From this Morningstar chart, we can see the FSSA Asian Equity Plus Fund actually had a pretty meaningful outperformance, and an increasing one, during 2011 to 2019. From 2020 to 2024, the fund delivered nearly the same returns as AAXJ, followed by a significant underperformance in 2025 and year-to-date. We can find part of the explanations by adding the iShares MSCI China ETF, or MCHI, into the chart. MCHI tracks mainly the China offshore market, and we can see the underperformance of this market in 2023 and 2025, as expressed by the increasing gap between MCHI and AAXJ during these periods. With a portfolio that has a strategic overweight to China, and with some of the top holdings from the China offshore market, such as Tencent, it is inevitable for the fund to underperform as well. It is therefore important that the fund can produce a better performance soon, like what it did before 2020, because it becomes increasingly difficult for investors to see a fund underperform for multiple years and not knowing when the brighter days will come. There are, of course, many factors involved, including changes in market conditions that are heavily influenced by geopolitics these days, but this is no excuse, as all funds face the same markets, and the better and luckier strategies will get more investor monies. Let's compare the fund against some of the other popular Asia ex-Japan equity funds in the market. Here is a 10-year chart where we can see quite a spread of different performance trends, even though these are funds investing in the same geographic region, showing that different active strategies can lead to very different results. We can also see the FSSA Asian Equity Plus Fund had held up decently well in the earlier years, and the main underperformance was from 2023 onwards. A shorter 5-year chart shows the transition better, where it can be seen that the fund was originally in the leading group but fell into the laggard group in 2023. Thereafter, in 2025, the fund further underperformed all the others in this chart. Again, it is important for the fund to pick up performance soon. Otherwise, investors will consider the many other better performing funds available in the market. Last but not least, Let's do a quick comparison between FSSA Asian Equity Plus Fund and its feeder FSSA Dividend Advantage Fund. As the FSSA Dividend Advantage Fund is essentially a Sing dollar unhedged version of the former, there are some small performance variations over time due to US dollar to Sing dollar FX movements, but not too significant except in the recent 2 years. So Singapore retail investors are not losing too much of the fund's actual performance through the Sing dollar feeder vehicle. With that, let's summarize our findings. An Asian-focused equity specialist team under the First Sentier investor, FSSA is reputable in the industry with various funds of long and successful track record. The fund's strategy of going for long-term investing in high-quality growth stocks that has gone through thorough fundamental research has worked over time and is good especially for investors looking for long-term investments through mutual funds. Fund portfolio exhibits a high conviction active management approach with notable geographic and sector differences versus the benchmark. The FSSA Asian Equity Plus Fund, which is the master fund in US dollar-based currency, runs an Asia-Pacific ex-Japan equity long-term capital appreciation focused strategy, which is pretty simple and straightforward. The FSSA Dividend Advantage Fund is a Sing dollar unhedged base currency feeder fund that has an additional regular distribution objective, as it is designed and created for Singapore retail investors that generally have income requirements. This is not a bad point, just that investors need to be aware of the differences between the two funds, as it leads to different share class offerings and slightly different performances. More specifically, some of the share classes offer distribution yields that are higher than the underlying portfolio dividend yields, meaning there is a negative impact to the long-term compounding growth of the fund NAV. Given FSSA is one of the earliest investors in the Asia equity market, these two funds have a long track record of over 20 years with strong since inception returns. Performance of the strategy, however, has been underwhelming since 2020, as market changes have not favored the high conviction long-term bets in the portfolio. Most notably, the fund underperformed in 2023 and 2025 by over 10% versus the benchmark index and most other competitor funds in the market, which is disappointing to investors. In summary, the FSSA Asian Equity Plus Fund and its feeder FSSA Dividend Advantage Fund have established themselves through their long track record, but underperformance in recent years is a clear problem, and the team urgently needs to improve on this. This concludes my absolutely biased comments on the FSSA Dividend Advantage Fund and the FSSA Asian Equity Plus Fund, and I hope it will help in your investment journey. May we all grow wiser and prosper.